This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Daniel Peris. He is a PhD, CFA, Senior Vice President and Senior Portfolio Manager at Federated Investors, Inc. in Pittsburgh. Before he went into asset management, he was a historian focused primarily on Russian history. Not exactly the background you expect to get to where he is today. And our conversation today is right at his new book, Getting Back to Business: Why Modern Portfolio Theory Fails Investors and How You Can Bring Common Sense to Your Portfolio. Now, this is a topic that I love. It's seen across my world, across my books, across this podcast. And as Daniel says, modern portfolio theory doesn't work anymore. He gets into the why and what you, as a smart investor, smart trader, should do about it. I love these types of conversations. I love to get into the nitty-gritty, and I want to learn from other people's perspectives. That's what this podcast is all about. That's what drives me. Bring as many smart and different voices together and see what we can all learn. Without further delay, let's jump right into my conversation with Daniel Peris. Daniel, modern portfolio theory. Perhaps my father, who's a dentist, who has been investing for a long time, perhaps he's heard of modern portfolio theory. Perhaps the average attorney that's making a couple $100,000 a year has heard of it. But I'm guessing still a lot of people have not heard of modern portfolio theory. But this is what governs the typical investor's portfolio today. That's a fair assessment, yeah?
Oh, it is absolutely the case, Michael, that the basic notions that underlie modern portfolio theory reflected in your 401k account, your brokerage account, in how investments are characterized, in the reporting that you might choose to get monthly or quarterly or annually, and certainly in the discussions that you have with a financial advisor and in the systems that a financial advisor or a broker have on their desktop, are all created around the goals defined by Harry Markowitz in 1952 and 1959, and simplified substantially by a bunch of other people led by William Sharpe in 1964 and 65. And those goals really reduced to two broad ones, and that is that diversification, which is, generally assumed by most people who you mentioned, those category of investors that you mentioned, to be a good idea. But diversification becomes a very quantitative and elaborate procedure throughout all of our investment lives in that format, in those 401ks and a standard kind of retail or high-end retail investment context, that you want to have a little bit of this and a little bit of that, because you actually, it turns out, get an optimal combination of volatility of your returns and actual returns by doing that. That's point one. And that's really what Harry Markowitz contributed to the mix. And there's a history, which we'll get to a little bit later, as to why that thinking may not be as solid as it was in 1952 or 59, but it still lives every day in the lives of most investors. The second part actually isn't really labeled as modern portfolio theory, but it emerged at the same time and is also ever present in our investing lives for most mass affluent investors. And that is the ideal investment. If you mix all of the formulas from the 50s and 60s together, the ideal investment is simply the market investment. It turns out to be kind of hard to define exactly what the market is. It's not just the S&P 500, it's whatever you can get your hands on. But those two notions emerged at the same time, and they still define our investing experience today, whether it's in ETFs and passive investments, or in the style box from Morningstar, or in the tools about diversification and expected outcome and expected variance from outcome, commonly the standard deviation of expected returns, that are on your monthly statements, your quarterly statements, and your annual conversation with your financial advisor. Now, for every single person who I just mentioned, they will all deny it's modern portfolio theory. But in fact, that is precisely what it still is. And everyone's trying to get, oh, well, I'm doing something a little bit different, which is fine. We're not following the pure version of modern portfolio theory, which is Harry Markowitz, who created it in the 1950s, said is hard to do. Everyone's denying it exists, but the whole framework is still very, very much in place for most investors.
So let me simplify this to something that we can all grasp onto. This essentially means that for the average investor working with the average investment advisor, the decision-making comes down to essentially giving everyone something that mimics an equity index in the US.
There are lots of advisors who want to be more active. And again, within the modern portfolio theory point one, which is getting the right combination of risk and return, there's plenty of room for active management. Just in the last couple decades, though, most people have said, I don't have the time and effort for that. I'm just gonna go passive. But it is true that even within a pure modern portfolio theory framework, there's a line that's the so-called efficient frontier, which balances a certain expected return and expected variance. And a lot of the portfolios are going to look alike if you are even playing that version of modern portfolio theory.
But that is where we are today, though, right? I mean, if we were to talk about the broad mass of the folks under the bell curve, it's index investing. Is that a fair assessment?
That's taken over. Yeah, we're still out there trying to, in my day job, still out there trying to point out that that's not a super idea, but it is true. It has captured the public imagination based on the academic work and popularization of it from many, many years ago, and presented in a framework that this is a way to optimize risk and return a la modern portfolio theory.
Pushing everybody into an index today, the academic grounding for that is MPT.
In the book, I make the argument that MPT, which is really Markowitz and Sharpe, emerges at the same time as the efficient market hypothesis, which is a bunch of other people, including some very famed economists like
Fama,
Paul Samuelson, and then popularized, taken out of the academic framework by Eugene Fama, who I had some email communications with on the book, and brought to the investing world in a retail sense by Jack Bogle and Vanguard. They emerged at the same time. And they're really quite different. The intellectual origins are separate. One of them is hundreds of years old. Modern portfolio theory is really from the 1950s, the way Markowitz and one other fellow defined it. But efficient markets is an idea that's been around for a long time. But they really come onto the stage almost at the exact same time in the mid-1960s. And then with the drawdown or collapse of the U.S. market in the mid-70s, the oil crisis and the various factors going on at that time, plus a regulatory change, meant that that's when both of these ideas, which are separate ideas, begin the process of making their way into investor accounts. Now it is what you might call the crowded trade, the dominant trade. The argument that one encounters and I encounter in my day job is that the best way to get to a reasonable MPT portfolio is through indexing. 30 or 40 years ago, that was a novel idea. 30 or 40 years ago, it could have been a good idea. And the history suggests it certainly wasn't a bad idea. The question becomes for investors, whether they go down a trend following approach, MICHAEL COVEL, or a getting back to business approach that I advocate. What's the outlook now that everyone, and close to 100% of the academics, side on index investing and passive investing? What's the right way to go to your futures? One of your prior guests on one of your many hundreds of episodes wrote to me, I don't own businesses. I own stocks. I'm not interested in the underlying businesses. And it's a powerful statement, which the book is calling out and saying, well, it is possible to go to a business ownership approach to these securities the same way that one would approach a private business, real estate, even one owns a job, and to look at them not from the perspective geometrically linked daily price changes, which is basically what modern portfolio theory encourages everyone to do, but to look at them from the cash flows that they receive, which is something which is not currently done to any significant measure. So my main argument is that modern portfolio theory and or index investing, but specifically the MPT part, has led people down the path of not business ownership through the market, but of speculation of, I call it in one of my earlier books, the Grand Casino. And it wasn't the intention of Harry Markowitz. It wasn't the intention of Eugene Fama, certainly not the intention of Eugene Fama, wasn't the intention of Jack Bogle, Vanguard, but that's what it's become over 40 years. And that's why my approach as a historian, I think, is helpful to me in that I want to make sure in any endeavor that I do that I know where the art came from, what the history of the exercise is, and say, is it still relevant? So modern portfolio theory and Harry Markowitz and raising diversification to a high goal. And by the way, there's a sub-story there to return to. Those were very important in the 1950s and 60s. They were addressing the issues, as Harry Markowitz said in a previous interview with you, he was still figuring out John Burr Williams, and he didn't like John Burr Williams from the 1930s. John Burr Williams from the 1930s was trying to figure out the crash. So Harry Markowitz, by derivation, is trying to figure out the crash and saying, hey, diversification makes a lot of sense. It's actually a better way to go about this. In the context of the 1920s and 30s, as reviewed by Harry Markowitz in the 50s, that's an incredibly reasonable, intelligent, and to be applauded statement. From the perspective of 2018, you run substantial risks by having 1,500 securities in your portfolio. Harry Markowitz never, ever envisioned that. But that's what Markowitz diversification has become in the form of an index investing. You have a whole lot of this, a whole lot of that, a whole lot of a third thing. You basically own the market and you take no business ownership stake in it. That's what I'm trying to object to.
Let me pause you for one sec. So the title of your work, Getting Back to Business, just so people have a flavor for it, because you haven't used the word yet, you come from a value perspective. At least people can grasp that. You haven't said that yet, but they can grasp that.
I self-identify, and we're in the age of identity politics, but I self-identify as a business investor, which is not a category that is available on the forms. It is, however, true that the cash flow type of investments that we make on the equity side, the book is broader. It makes an argument about incorporating all sorts of investments, public and private. But on the public equity side, the dividend types of investments that meet the criteria of getting back to business are generally viewed as a subset of value. Value investing is broader. There are more things going on. There are plenty of ways. Actually, I'm pretty sympathetic to them. And so you are correct. I have a bit of a value mindset, but there are plenty of ways of being a value investor that don't involve accessing distributable cash flows the way that I'm advocating. But it is fair to say this is a subset of value investing.
It wasn't implying anything negative. I'm just kind of making sure everyone has a flavor for where we're going. So, you mentioned we don't really need to go there now. I go there enough. But you mentioned trend following, a form of momentum, time series momentum. And then you've got value. And then we've talked about index investing. So I think people can understand that a value perspective, without getting into all the nitty gritty of your world, a value perspective is going to be quite different if, let's say, your portfolio is, under 100 markets or whatnot. That's going to be quite different than an index perspective and quite different than a momentum perspective time series. Give me the really clear, I'm sitting here thinking, why does one even need diversification into 1,500 stocks? That's overkill. But why don't you go ahead and lay out the perspective? Throw the dagger in the heart of what MPT has given us in terms of what the average investor has and why it's just not a great idea in 2018.
Simplest terms, Harry Markowitz does his work in the 1950s, at which time individuals may have had 4, 6, 8, 10 investments. Single digit, very common. He advocates a more sophisticated approach that suggests that the optimal outcome in an ideal world, and he had rational actor theory underpinning all of this, which is a whole separate conversation and interview, and you've had some wonderful interviews with behavioral finance people pointing out, and you yourself in your comments have suggested it's not a great way to underpin an investment strategy using rational actor theory. But he suggested within a rational actor theory that 4, 6, 8, 10 investments is suboptimal, that you want to diversify in the best way to achieve a better outcome that is a lower variance. And again, you can argue whether that's how people define risk and return. The optimal outcome is diversification, as opposed to Carnegie's put all your eggs in one basket and watch that basket, or Loeb, Gerald Loeb, also basically applied Carnegie. So Markowitz is answering that and saying, that doesn't make a lot of sense. You actually can do better with a diversified portfolio. In his wildest dreams, and again, it'd be, if you can get him back on and ask him, because I believe he's still alive, you can ask Harry Markowitz whether he considers 1,500 securities ideal diversification. And the answer most certainly is no. Markowitz says, hey, listen, folks, you'd be a little bit more sensitive to diversification. It actually leads to mathematically somewhat better outcomes. That is not the same thing as saying you should have thousands upon thousands of tiny, insignificant investments in your portfolio and throw in the towel on decision making under conditions of uncertainty and being a business owner.
Throwing in the towel means you basically are just giving up and saying, whatever the S&P gives me is what I get. And if we get another 50% drawdown in the S&P like we have in the last 15, 16, 17 years, then that's what you get.
Yes. And now they would say, well, if you own also emerging markets and you own the Canadian market, you're going to have a slightly different outcome. But basically, you're not making any active choices, as opposed to, say, in your private life where you choose a spouse, in your private life where you choose a job, in your private life where you choose to live in Saigon or Pittsburgh. We are tasked as adults to make decisions under conditions of uncertainty. It's the profound challenge of being a human. And yet, because of some of this math from the 1950s and 60s, and if you go back and read the original material, it is so redolent of the 1950s and 60s. Math is going to solve all of our social problems. That's why it's called social science as opposed to politics or history. In your schools, it's now called social science. We've got this figured out. Well, that was the atmosphere of the 1950s and 60s. And the best answer from the 1950s and 60s was don't make any decisions. Just hoover it all up. And at that time, that was a very popular intellectual choice. And when Bogle introduces his products in the mid-1970s, it's a very popular choice. Circa 2018, when this interview is being recorded, and I understand they have a shelf life of several years, but circa 2018, actually, if I can, I'll say October, late October 2018 to mark the time, investors have to ask themselves whether that non-decision making is the best approach going forward. The U.S. stock market's at a certain level, a few percent off of its all-time highs. You have the U.S. economic situation is what it is. It's either strong or weak, depending on your view, and the outlook is what it is. Do you say, I choose to make no decisions whatsoever? Do I choose not to hire someone to help me make decisions? Did you apply the same standard for your personal life, your professional life, where you live, what you do, how you spend your time? Most people make an effort at decision making under conditions of uncertainty as they go through their lives. In modern investing practice, the way it is set up now, you're encouraged to just, as you say, throw it all aside and say, well, I'll take whatever's given to me, and that's about it. I've had many of non-professional investors say, well, I don't really have the time to do this. I'm just, I am spending time with my family or my job or my side businesses where I do make decisions. I don't have time to look at every company earnings. And I'm not suggesting that. There are financial advisors. There are information resources available for that. There are packaged products. Now, they're not very popular in the academic sphere other than index funds, but there are ways to have other people help you make decisions. Again, you don't do your own brain surgery. You don't do your own dental work. You do hire a professional to help you with that. You can make decisions, informed decisions. Hopefully you get 51% correct. That would be an outstanding score over time about your investment decisions, the same way you would like to get a high score on your life decisions.
You were mentioning the 50s and 60s and the quantification of everything. And you mentioned Saigon. I don't want to go there because it's a much longer conversation. But for people that are not aware, that quantification was something that the Defense Secretary, Robert McNamara, employed quite a bit in his war strategy in the 1960s. Everything was quantified, and that quantification really didn't work out so well.
There are lots of social, and this could veer into dangerous political territory, but there are lots of social programs and international policy issues which were based on the assumption of rational actor theory and quantification. McNamara got to start during World War II looking at the numbers of B-17 crews heading over to Europe and how that could be optimized. And he applied that when he then was in charge later, the subsequent war. There are lots of social programs and lots, again, of political matters from that period about achieving kind of the best possible outcomes, which is a great sentiment. It was just overreach. So one, it's easy to critique me for constantly talking ill of quantification. Let me be very, very clear that from the mid 19th century to the present time, the benefits of quantification of human behavior are substantial in pretty much everything that we do. It is possible, however, to overreach. It is possible to go down an approach and say, we try to quantify this 100%, and that turns out not to be a good idea. That still allows for the basis of quantification having helped society in most endeavors to some degree. But the argument that we are going to have a quantitative 100% effective solution for making choices, making business choices, that's a stretch. That's a stretch. And yet that's what the combination of MPT and passive investing has basically offered investors who aren't paying attention. And again, I understand most people, the doctors and lawyers that you referenced at the top of the show, may not have an interest in this, but they have 401ks. They don't have a choice. They're captive audiences. They have to do something.
If they don't have an interest and it's their money, ultimately, I just got back from giving a little presentation at the Bellagio in Vegas. If it's their money and they don't have an interest, I mean, they're just throwing the dice. You know, it's kind of crazy if you think about it. All these professionally minded people, they get all the academic chops, they make some money, they put it in the bank, they give it to the advisor, and then they just turn it all off. And I think that's kind of the big picture point you're making here.
The hard part of my argument is I'm asking people to give a damn. That is, I'm asking people to make decisions or to hire someone to make decisions in the same way that they've made decisions for the rest of their life. There's a wonderful comment from Ben Graham about people entering the market, that successful business people having achieved a great deal. Basically what you just said about, your audience at the Bellagio, and then abandoning all of the precepts, thinking, logic, and discipline that they exhibited in work in the first place and just giving it all up to a casino-like betting in the stock market. He found that odd. I find that odd. And I don't think it's absolutely necessary. So that is all too common, however, all too common.
I'm going to let you drill down a little bit further here so we can really, when you're sitting alone or you're talking with associates and you're really talking about how MPT in 2018 can go drastically wrong, map out for my audience how those folks out there that are listening that, perhaps they like to think of themselves as progressive in their investments and perhaps they've looked at some alternative type strategies or whatnot, but the reality is they're 100% index. What is the risk beyond? I guess the most drastic risk is just going down with the S&P, taking another 50% hit, and then having that maybe go sideways for 10 or 15 years as opposed to bouncing right back in a couple years.
We define the risk a little bit differently because of my proposed solution. So the book is 2/3 of the history, the critique, and saying, hey, folks, you're using an outdated system. You may like it, you may not like it, but please know the history of it and what it was designed to come up with. It was designed to come up with some solutions for the 1930s, and it was just filled with the heady confidence of 1950s and 60s social science. That's where we are. That's the system. I think it's not a great idea. Make your own choice. My proposed solution, the last part of the book, and this will help me then answer your specific question, is a cash flow-based investment strategy that looks a lot like private business ownership, but private business ownership through the public equity markets. And to do that, you have to look at the cash flows and the NPVs of the distributable cash flows that you, the investor, receive. In the same way that you have your take-home check, that your plumber insists on cash payment, not little bits of paper. And pretty much every business outside the stock market runs on a cash basis and is judged either successfully or not based on the distributable cash flows. My proposed argument, I'm not suggesting it's the only other way, anti-MPT, to run an investment portfolio, but it's the one that we've advocated in the portfolios that I manage, that you bring a business-like sensibility based on the cash flows. So from my perspective, risk, and here's a choice that investors, your listeners, can make, is their definition of the term risk. For us as a business venture, that our definition of risk is that the cash flows don't make it to the end client, that the income stream that we define and aim for, and the growth of the income stream, that ends up being the hard part on the equity side, that the income stream and the growth of the income stream don't materialize as much as we seek it to be. And that the NPV, the IRR, the DDM, these are all acronyms, so they basically amount to the cash flow that we're trying to deliver to clients, whether the grandmas who needed to pay their monthly bills or just business people who measure themselves on cash flows. We define risk as falling short of our targeted goals.
You don't like risk in terms of being defined as the loss of capital.
If the cash flows are rising, the capital is going to do well over time. And the evidence bears that out. But most people, to your perfect segue, most people are defining risk as near-term share price movements. A reasonable person, a value investor, would define risk as long-term share price movements and capital protection. Unfortunately, the entire industry, and you know this as well as anyone, the entire industry is set up in terms of geometrically based daily price returns linked, becoming monthly, quarterly, yearly. And the television's on every day. Everyone ends up being a short-term investor. Even less so the trend following. Trends can last for a long time. All too many would-be trend following investors don't have the patience to actually sit through the trend. You can opine on that. But the idea that risk is, in my mind, and this is straight from Ben Graham, I didn't come up with this, or I would say every business person on the planet for the last 5,000 years has come up with this, other than U.S. stock investors. Risk is primarily the cash flows that you have that are distributable to the owner of the business, public, private, domestic, foreign. It doesn't mean there isn't room for startup businesses. It doesn't mean there isn't room for biotechs or social media companies that aren't going to have cash flows for many, many years. It does mean that when you approach those businesses, you understand that there's a much greater degree of risk compared to a company that does have distributable cash flows. And again, as many of your behavioral finance guests have commented, you need to have some mental space for those types of investments. They're like lottery tickets, and there's nothing wrong with that, and people should feel free to pursue those. But generally for us, for me, for my team, sitting around the water cooler, when we're thinking having a good day or a bad day, it's about the cash flows that we can distribute to our clients and whether they got better or worse, whether they've not changed at all. That's a profoundly different form of risk than what's common in the marketplace. Now, to answer your question specifically, we're sitting in October of 2018. Assets are at a certain level. The U.S. stock market's a largely dividend-light zone. It has a 2% yield. Show of hands, please, everyone in the audience who feels that a 2% cash yield for an ongoing business enterprise is a good return. I would argue it's not. Even if the cash is growing at 7 or 8% a year, it's still a miserly return. The U.S. stock market's yield is been at that level, around 2%, for several decades, actually longer than I've been managing my portfolios. It's just hard to make a business from an index investing perspective to get a cash stream out of the U.S. market that looks like any other cash stream that you might have. And again, there might be good reason why some people don't care in 401k accounts or for 35-year-old investors who don't need the cash or want the cash. There may be good reason, and they enjoy speculation. They may good reason that they are perfectly content with a non-cash flow based business investment.
This would be defining most of our tech investments of the last 20 years.
It would be, and a fair criticism of my position is that had NASDAQ not been a dividend-free zone, would we have all of the wonderful toys that we currently have? Those companies, without the discipline or the obligation upon turning profitable and getting a little bit of scale. Again, it's not reasonable to expect small companies, startup companies, to pay dividends. But when those companies became profitable after 5, 7, 10 years, should they have started making distributions, there are instances, well, we wouldn't have all these toys if we had to have made distributions. That, I think, is patently absurd, that the discipline of success, of making a profit distribution to company owners, makes for better investment spending, not worse. And the past 20 years shows countless examples of tech companies buying one another and then writing off almost the full amount. I have a couple examples in both Getting Back to Business and also in a prior book, The Dividend Imperative, as that not having the discipline of a dividend means companies, frankly, make worse decisions. I have a teenage child. At the behavioral finance level, it's pretty obvious to observe. If you put a lot of money in this kid's pocket, it will be ill spent. If you put a little bit of money in this kid's pocket, it will be less ill spent because he'll just buy a necessity. I'm not suggesting that the tech companies are like my teenage son, but there is some parallel about not having any restrictions on your spending behavior. One of the benefits of a dividend in an equity context is it's a form of discipline. The companies, frankly, perhaps they don't have a lot of money going into the candy stores, the kid in the candy store, and so they have to make better decisions. Let's take it as granted that we might not have all the tech developments over the past 30 years if the NASDAQ had not been a dividend-free zone.
Does this also mean that you would have not, We don't need to get into the specifics of your day-to-day world, but does this mean you would have avoided the Amazons, the Apples, the Facebooks, the Googles?
It is fair to say, and again, without touching products, the portfolios that I manage are based on this cash flow approach. Therefore, the non-dividend paying securities that are available in the US stock market are not, I like to say, they're not underweight, they're at zero weight. They're not even part of our opportunity set. Now, most investors don't just own 100% of the product that I manage. They tend to barbell it. You characterized as kind of a value strategy in the eyes of many financial advisors. It is that. And so they barbell it with something that has, often barbell it. I can't guarantee what every advisor does, but they often barbell it with some sort of growth strategy that has representations from those securities. In the meantime, we're the income producing, the tortoise, we're the tortoise, and the hare has those other securities that you mentioned. We're the tortoise part of the portfolio, and we're very happy in that regard.
Now, are you also, in what you're proposing as the solution, would you find yourself burdened by any type of benchmarking that you would have to adhere to?
Yeah, we do benchmark ourselves internally against absolute numbers. And, was our cash flow distribution up by a certain amount? Did our cash flow distribution represent a certain amount of our starting assets? So we actually use absolute numbers in our benchmarking, and we're getting close. Ironically, we have some domestic and international products. The benchmarks on the international side, for reasons that I can get into, there's dividend investing still popular outside the United States. The actual stock market benchmarks, which most managers are subject to, and you measured against them daily, weekly, monthly, et cetera. The international benchmark, dividend benchmarks aren't that bad. Curiously, the design and manufacture of domestic security dividend benchmarks, because this is not a dividend market, to say the least, are pretty squirrely and unusual. And we have domestic benchmarks, but none of them capture cash flows very well. And since we're trying to deliver a high and rising income stream from high quality business assets, it becomes harder to measure in that. I am primarily compensated in my day job vis-a-vis the absolute benchmarks. Was the income that grandma got from the products that I manage up versus last year? And was it a munificent amount, significantly higher than the market's 2% yield? It's a business benchmark as opposed to a relative stock market benchmark.
In our limited time, let me take you back in time a little bit. I want to go to two particular names that we've already discussed. We've discussed what they are famous for. We've discussed Harry Markowitz. We've brought up MPT. You brought up Eugene Fama, the efficient market hypothesis. Let's start with Fama. He recently won a Nobel Prize in the last handful of years. He won it for this. It was interesting that he won it the same year that they gave it to Robert Shiller for behavioral finance work. So that leaves us people out there and the proletariat looking at that and going, well, that's kind of an interesting choice. That seems to be at odds with each other. But why don't you go ahead and map out, because I've written some things where I start to really say, well, gosh, has he delivered all that work he's done? Is it really something that's useful for us in 2018? Why don't you map out from your perspective, and you've mentioned you've had some communication with him, why don't you map out his innovation, why he got the Nobel, and perhaps some nugget of insight about his work that you really like?
My approach is as a historian, and everyone should know where Eugene Fama, Ken French, his colleague of many years, are coming from. The original mathematical work about that markets are efficient comes from a late 19th century French economist and mathematician who studied the French bourse. And his story is just so wonderful. It's in the book. It's in everyone's book. It's in Justin Fox's book. It's in my book. It's in everyone's book. And he was crowned in the mid-60s. And basically it is, even though he died in 47, the arguments are efficient. Argument made within academic circles is crowned in the mid-1960s. His thesis is republished, and all of the leading academic lights of the day basically say, yeah, he got it right first time around. Congratulations. He had died in 47 in obscurity, unfortunately. Gene Fama gets credit, along with a handful of others, but Gene Fama is really associated with it, of taking the argument from outside of academia. I mean, these are people who historically, at the University of Chicago or elsewhere, were just looking at data sets. And they would write it up in academic journals and their dissertations and then teach it and say, this pile of numbers has no pattern to it, just like that pile of numbers has no pattern to it. That's fine, but it's not going to affect Gerald Loeb, who we mentioned earlier, and it's not going to affect mainstream investing in the 1960s, which was still all about, in the 1960s, chasing individual growth stocks, the Nifty 50 and many of the tech stocks of the name. They were computer leasing stocks, and these were big computers, not the type of computers that we know of today. But Gene Fama gets credit for going from academia to Wall Street and saying, you're all engaged in a necessary but foolish enterprise. Necessary because in order for the market to be efficient, you need to have hundreds, if not thousands, of people assuming it is inefficient and making investment decisions, their best investment decisions that they can. And if you have those thousands of people trying to make good calls, then you end up getting an efficient market. So it's a wonderful, delightful paradox that in order for the efficient market to be successful in practice, you basically can't have anyone believe in it. That's another reason, 50 years later, to question whether markets are efficient. A, we have all of these ups and down strokes, which shouldn't really happen in an efficient market. But B, if everyone has thrown in the towel and is just buying index investments, where's the efficiency? We could look at any number of large cap securities. I prefer not to mention individual ones, but they used to make light bulbs, white goods, and jet engines, and say, were there thousands of people looking at that business or any of the more new economy companies that are very, very volatile and move up and down? Do you have thousands of people looking closely at the numbers and making an investment call, or do you just have everyone in index funds, often market cap weighted index funds, which just buy more of the winners and sell more of the losers? And again, from a value investment perspective, that's a great picking field to be a value investor because you look at the bottom half of that list over time. So Fama gets credit for not just having an academic idea and formalizing the work of Batchelor and Samuelson and a bunch of others in the 50s and 60s, but formulating it, the weak, the semi-strong, and the strong thesis about market efficiency, and taking it to Institutional Investor, with a brand new journal at the time, and taking it to institutional investor conferences, and appearing in the Financial Analyst Journal, and appearing at investor conferences, and getting into the trenches with investors, which had to have been a very difficult task because he would have been met with significant resistance. So credit to him. The second very interesting part of his work is that in later decades, in the 1990s and the 2000s, he actually begins looking at the factors. Remember, the efficient market hypothesis emerges in 1965 along with CAPM. CAPM, modern portfolio theory and efficient markets, all come together in one spark in the mid-1960s as saying, hey, according to CAPM and modern portfolio theory, CAPM we won't get into CAPM, it's kind of late in the day as it were in the interview, but a simple formula that encapsulates expected returns and expected risk. And remember, modern portfolio theory is about getting an optimal combination of expected returns and expected risk. CAPM is a simple formula for doing that, and it turns out that the optimal portfolio is the market portfolio itself, therefore index invest. Having been part of that mashup, wonderful mashup, a period of tremendous creativity in the mid-60s, in later decades, Eugene Fama says, I think one of those formulas is a little bit off. And that's the CAPM. It's the weakest formula of the group. And that simple formula, it's too simple. There needs to be a couple other factors that explain returns and therefore risk. And so he and Ken French came up with not a single factor model, which was the original CAPM, with the single factor being sensitivity to the broader market, but then a 3-factor and a 5-factor model, which they now believe explain a lot of market activity. Now, the irony, the delicious irony from my perspective, is that in the evolution of Eugene Fama, but when you have a 5-factor model, is it really fair to say it's passive investing or efficient markets? That's a lot of factors, actually. It's suggesting that there's a lot more complexity underlying the market than is supreme. It may not be individual security selection, it may be factor selection, but that itself is a form of active decision making about what factors to choose and how to weight them. In later years, Fama isn't quite as simple passive investing as it had been in the earliest version.
You know what's so amazing about where you've gone in this from a history standpoint? It is terribly interesting to really go back in time, and I wish so many of these folks were still alive, like Benoit Mandelbrot or Peter Bernstein, et cetera. Samuelson. It would have been so much fun to dig through so much of their work and their minds. But it's such a fascinating time in the sense that here we are, you and I keep saying this in the conversation, it's 2018. What can you do differently than just be an index investor? I mean, that's ultimately got to be the theme of this conversation. What are your choices? What can you do differently? And, frankly, both you and I, whether we agree or not, both of us are actively putting something out there that's quite different in our writings than the passive indexing.
In contrast to this, don't make a decision, you in trend following have a proposed series of decision-making tools for investment purposes. I have a diametrically opposed one, but at least it's not the passive approach.
They're both not passive.
They're both not passive. They're very different. And that's wonderful. The investor can make a choice. They don't have to have their hands tied. If they are 35-year-old and, shall we say, of more speculative nature, and it's money that they don't need for the rent or for future safe money, then the opportunity for trend following is a tremendous opportunity for them. In my case, it's business investment for people really focused, probably more conservative investors, let's be honest, who run their own businesses, lawyers, doctors, business people, retirees who actually are less sensitive to capital value than they are to the income generated from that capital value. People who may not like all of the shenanigans on Wall Street. There can be any number of reasons why a person might want to approach the stock market from a business perspective as opposed to a passive investment perspective. Now, going to your financial advisor or going online and doing it yourself is hard but not difficult. Finding a financial advisor who will say, I want this money managed for income generation and income growth, and I'm not that concerned about having 1,500 different securities because I think that's excessive diversification from a common sense perspective. That's one way. You can do it online. There are products out there and there are online platforms. You just have to look at the yield. And the SEC and distribution yield were calculated for bond funds, bond products, not for equity funds. You have to kind of look into the details there, but you can see the yield and dividend growth of products. You can say, a 4% yield is higher than a 2% yield. You do not have to have a CFA or a PhD in finance to identify the parts of the U.S. investment spectrum that are cash flow oriented. It's a smaller part than all the tech and social media parts, and those that are not. And you can make choices about that. The best way, I would argue, is to have a financial advisor who has all the tools to do that. But again, near-term relative benchmark performance, how'd you do against a benchmark on a share price basis last month is not a great way to run a railroad. Instead, the question is, what did my assets generate last month? And compared to the month a year ago or 5 years ago, is that number flat, growing, or declining? And can I make business decisions about the types of assets that I want to own to achieve a better combination of income generation, income growth, and volatility of that income stream, the same way you might make about any other business decision. Now, I'm not saying it's super easy, but it can be done, and it just involves having the courage to stand up to an existing paradigm and say, yes, I understand that's how it's done now, but that was created in the 50s and 60s, and it was a very clever solution to some 1950s and 60s problems. But for me to have, again, 1,000 or 1,500 securities in my 401k because I own 5 or 6 index funds is a choice that is a choice. You don't have to follow that rule set.
The book, Getting Back to Business, I have to pay a compliment to you. One thing that I really enjoy about your style of speaking. So I know just by talking to you only for this initial hour, and we'll have to have another conversation in the future, but I could easily turn you on for 3 hours. Maybe you would get tired, but I have a sneaky suspicion that you would fill more words into an hour than almost any guest that I've had on. Fabulous. Really, you are really, really good at it. So I appreciate that because you're really throwing a lot of detail, and the book is a ton of detail too. So people really can go back and they can dissect and see how this has all unfolded to get to where we are today. And look, sometimes when you try to bring up a new discussion like this, people might not really pay too much attention, except you and I both know what happens. At some point in time, that S&P will head south. And when it does, that's going to be when people are saying, hold on, what else is out there for me? What other solutions do I have? This passive thing, did it work?
It was an important emergence point for modern portfolio theory and ultimately index investing. Was the ideas were created in the 50s, refined in the 60s. Nobody paid attention until the 1973-74 drawdown. There was no reason. When the market appeared to be doing very well in the early 70s, after a drawdown in the late 60s, but it recovered rapidly in 71, 72, there was no reason to listen to these pointy-head academics about optimization or mean variance optimization. What is all that? There's no reason. Stocks are going back up until 73, 74. And then a lot of people were very upset, and they said, we need some new tools. That was the entree for MPT. Well, 40 years later, you can make an argument, and there's no need for a change of system. Everything's working fine. The market's basically close to an all-time high. I suspect you are correct. I'm not a bear market person, but if there were another material drawdown, that will be the opportunity for many more investors, not just cranky, semi-academic dividend investors, to examine the system and say, maybe there's a better way. And by the way, maybe there's a better way. It was a comment from James Verton in the first version of the Journal of Portfolio Management in 1974, founded by Peter Bernstein, characterizing MPT as a better way compared to the Gerald Loeb Carnegie method that had existed prior to that time. So I quote him, ended by quoting him saying, maybe there's a better way. People just need to have the catalyst to look for it.
Again, the book, Getting Back to Business. Daniel, where can people best go to find out more information about you? They can easily find the book on Amazon, but where's the best place they can go online to find more about you?
Thank you, Michael, for the plug. So the personal website is strategicdividendinvestor.com, strategicdividendinvestor.com. And for the day job and the products that I manage, it's federatedinvestors.com.
Daniel, I appreciate it. Again, I do hope sometime in the years to come we can say, heck, let's do a really long form one. We didn't schedule a long one for this one, but I know with your background, we could really get in depth. When we know from the beginning, I mean, if you want to do it, but we know from the beginning we might go for 2 or 3 hours. That's really fun to really get that historical foundation laid down. So we'll have to do it again in the future.
Absolutely. And then we can get to Russian history.
That's always fun too. Daniel, I appreciate it. Thank you.
Thank you very much, Michael.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.